financial markets in turmoil.
What are the root causes of the financial crisis?
The dollar losing value.
Heading for its biggest loss in nearly 3 decades.
Will Social Security even be there?
I don't know.
Buy or rent?
That's a very good question.
Interest rates.
I'm not so sure.
Where do you put your money?
I don't know.
Welcome to the show that answers your questions. This is Follow the Money Weekly with your host, economist, and best-selling author. Here's Jerry Robinson.
Friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride. As you can see, today's episode number 412, the bubble is bursting. It really doesn't matter where you look when it comes to the financial markets, whether you're looking at the stock market, whether you're looking at the crypto market, or whether you're looking at the bond market. We have seen big carnage in 2022. Since we peaked last year, we have been seeing a lot of downside. Just taking a look, for example, at the S&P 500, which is trading down over the last 5 days around 8%. But if you look at year to date, we're down around 17%. That is quite a walloping for investors to have to suffer. In fact, the S&P is suffering its longest weekly losing streak in a decade. We've had several weeks now of ongoing losses. And of course, the NASDAQ is no different. The NASDAQ has recorded its first 5-week losing streak since 2012. On top of that, of course, you have the dollar, which has recently hit a 20-year high. And that rise in the dollar, of course, which recently broke out above the dollar index, which broke up around 104, which again, it hasn't been there since the early 2000s. And of course, the dollar is rising on expectations of more rate hikes from the Federal Reserve. Of course, the Federal Reserve has been raising interest rates. Its Fed funds target rate, it raised by 50 basis points just last week. And the market initially had a relief rally, but it was a very brief relief rally that was followed by, again, more selling, right? So we have seen a lot of selling in the stock market as a lot of pressure due to inflationary fears. Inflation now, of course, remaining near 40-year highs. We also have the 10-year yield, which has risen to the highest level since 2018. Remember, 10-year yields were well below 1% just last year, and they have soared immensely over the last several months, now, above 3.1%. I think they've actually pulled back a little bit from that since we got this week's latest inflation report, which showed a slight pullback in the overall official inflation rate here in the United States. Now, economists were actually hoping for a slightly less robust inflationary report. What we saw actually was an 8.3% consumer price index gain in April, and that is more than the 8.1% analyst estimate. And it means that, of course, inflation is still near 4-decade highs. When you break down and you look at some of the other components of the CPI, you'll see that the core CPI was also higher than expected. Shelter costs, which are extremely important to the U.S. economy, those rose at the fastest rate since 1991 in the month of April. So it's really been challenging in this environment. Now, of course, if you've been listening to this podcast for any length, you know that we were talking about inflation some time ago right here on this broadcast. Just looking here through the catalog and back in episode number 380, which was in December of 2020, we did a podcast called The Coming Commodities Bull Market. Well, we certainly had a massive rally in commodities in 2021, and that continues now into 2022. We also did, if you want to go back in our archive and find some more information about this topic, we also talked about in episode 389, the title was Inflation is Here. That was recorded almost exactly a year ago now in May of 2021, warning you that inflation was going to get rowdy, and sure enough, we are here. We also talked about hard asset investing back in episode 398. And volatility is back in episode 402. That was back in December of 2021. So, and then of course, at the beginning of the year, we began alerting our members about 4 different ways to play a bear market. There has been a very sharp sell-off, of course, in many stocks. If you look at the indexes or the indices in the stock market, you'll see that they have fallen. I mentioned that the S&P, for example, is down about 17% year to date. The Dow Jones, meanwhile, is down about 12% year to date, and the NASDAQ 100, the ETF QQQ, down 26% year to date as of this recording. So obviously, the indices have been hit pretty darn hard, but when you look and go underneath the hood, you'll find that many stocks, especially high growth stocks and tech stocks, have just been hammered. I mean, to the tune of 70, 80% haircuts in many of these stocks. And many of the stocks that have really been hit are the ones who are not quite, fully profitable yet. They're the ones who have high growth potential. There's a lot of potential. There's a lot of, excitement about the technology or whatever the company is doing, but they may not have material profits. They may not have, rising revenues, rising earnings. And this just puts, this has just been a real difficult time for those kinds of stocks. And even high quality stocks that we would call high quality. I mean, think about companies like Apple. Apple is down around 17% this year alone, but of course it's sitting on a massive pile of cash, roughly $200 billion. So that's a kind of company, and we own Apple. We like Apple for the long term and have been buying it, even recently, dollar cost averaging. But, Apple is one of these companies that we think is going to do well because it has a very strong financial cushion, and it's going to continue to invest in research and development despite the current sell-off. Other stocks that are doing well here, Microsoft, which is currently sitting on about a $105 billion cash pile. Amazon also sitting on about $85 billion in cash. And so there are plenty of companies right now that are well positioned, but they're still going to probably see their price fall even more until this overall sell-off comes to an end. So again, we have been seeing a big wipeout in many companies. Now, we recently were talking about this to our members here at Follow the Money. So every week we do a live coaching call during the market hours. So I'll get on and I'll talk about the markets, provide economic commentary, market commentary, do a teaching of some kind, and then we also answer questions. And one of the things that I was talking about on the last call this week during the live call was the fact that in order to see this current sell-off come to an end, there's really, I would say, at least 3 things that could bring it to a halt, and we would begin to see a real meaningful rebound. Those 3 things, and you could probably think of more, but the 3 things that certainly stick out would be once stock prices reach a certain level, it begins to kind of trigger buying by algorithmic traders, or high frequency traders, and even certain, hedge funds and mutual funds who will begin to, add more based upon a tactical approach or whatever. So, once stocks get down to certain multiples of their PE or their PS, it just kind of triggers some buying for sure. So you could have that happens. However, the other 2 more meaningful things that could happen, I think materially speaking, would be first, you could have the inflation begin to show signs of topping. Now, that was the hope from this latest report that came out for April. Investors, analysts were hoping that we were going to see a beginning of a decline in the overall inflation. And it is true that we got a lower inflation print in April. It pulled back slightly, but it was still above expectations. So is it possible that inflation has already peaked or is peaking currently? It is possible that could be happening. And I also think it's important to remember that the other thing that you can do, and I think this is really helpful, a good way to track inflation on your own, you don't have to rely, of course, when you rely upon the Federal Reserve, you're relying upon their official numbers, and their official numbers, of course, are pretty fudged. I mean, they really, when you look at the actual components that they measure for inflation, they've changed over time. It's a pretty dishonest basket, the way that they do it. But regardless, if you want to follow the numbers that they would be following, you can go online to something like the Federal Reserve Bank of St. Louis. There's the Federal Reserve Economic Data website. FRED is what it's known as. And you can look at the 5-year and 10-year inflation expectations. And when you do, you'll find out that the current rate of inflation right now, which is above 8%, is certainly not the expectation for inflation going out 5 or 10 years. Now, how do you determine what that inflation expectation is? Well, it's real simple. What you would do is you would just basically take the difference in the yield of the 10-year Treasury bond and the 10-year TIP, or the Treasury Inflation Protected Securities. And if you take those and you look at the difference, you'll find that the average expectations for inflation going out, say, for the next 5 years is around 3%. So that's the expectation now. If expectations were higher than that, the Fed would be, in a world of hurt. Obviously, the current inflation that we're feeling now, is it going to last 5 to 10 years? Well, investors aren't expecting that. And that's one way that you can kind of measure. Just notice the difference between the 10-year yield and the 10-year tip. Obviously, this has created a lot of scare in the market, and many people are concerned about the volatility. One of the things I also recently mentioned to our members, and I want to share with you here on our podcast episode, is the fact that the volatility, as bad as it is, it's not really the greatest problem that you have if you are a long-term investor. You see, this kind of wild market action that we see is obviously part of the system. I would call it healthy, but I don't think there's really anything healthy about this over-leveraged system. So I don't want to use that word, but I would say that there's certainly some good that will come out of this big, hefty sell-off, as we see a lot of stocks that were just simply overpriced. I mean, just think about what we have witnessed over the last 2 years. Did you ever find yourself just sitting around asking, why is the stock market soaring? Remember this question that everybody had back in 2020 and 2021, where we were looking at the economy and, it was not doing very well, kind of limping along. And we saw all of these food, bank lines at the food banks, and people were going hungry, and all of these problems and concerns about employment and jobless numbers. And yet the stock market was just literally going straight up. You remember this, of course. Everybody remembers this. It was a wild situation. And this, of course, was because the Federal Reserve had just pumped in a tremendous amount of money. You also had fiscal policymakers as well in the Congress and in the White House, pushing out money, pushing out checks to individuals. So it was driving up the amount of money. But the Federal Reserve, the amount of money that they printed and the 0% interest rates that they delivered were just, it was so jaw-dropping. We had never seen this kind of monetary intervention in any economy ever, never to this level. And so one of the comments that I had early on was that you can't expect to have this kind of historic economic intervention and not have any consequences. And what we're seeing today are the consequences. Much of the air that was blown into the balloon to stave off any kind of economic reality for investors is now coming to the investor, right? The investor is feeling the pain, right? We're seeing the prices fall across the board. Now, it's not just the stock market. We could go on there for a while. I think there's going to be a lot of opportunity here. I don't want to suggest to you that the market here, by saying that the bubble is bursting, to lead you to believe that there's not opportunities. In fact, there are some really, really great opportunities that are going to occur. And I would say right now would be a great time for you who are investors out there to be, making that shopping list of those companies that you would like to add to your long-term portfolio once they fall to a certain level. Once they pull back to a certain level and they kind of, fall into that sweet spot that you've been wanting, now would be a great time to do that. Some people are actually even selling puts right now as a way of trying to take advantage of that, where you can actually earn an income while you're waiting for the stock to fall to your level. We actually we talk about that in our options trading university. We have a lot of stuff to say on options, but there's different ways to play this. Additionally, those who have been making money on the downside, right? So using inverse ETFs to make money as stocks go down. There's been a lot of that going on as well here with our members. Now, it's not just the stock market, as I mentioned. There's also bonds, and bonds were one of the worst places to be for the last couple of years because, well, the last several months, because everybody knew that the rates were going to have to go up. And this, of course, bond prices work inversely with interest rates. So they go down when interest rates go up. So, you had that situation in bonds, but then you also have the crypto space. And the crypto space has been wild in 2022, but especially over the last couple of weeks. So we've seen across the board a very hefty sell-off in cryptocurrencies. And this is kind of how you have to expect the cryptocurrency market. This is one of the reasons why when you see this kind of volatility, this is why we only invest a nickel out of every available investment dollar into the crypto market. We want exposure to the crypto market. We've had exposure to the crypto market for about a decade now, but we don't want to have too much exposure to it. And I think this recent sell-off provides the reasons why. I mean, the volatility in the stock market is bad enough, but when you get into the crypto market, I mean, volatility can be outrageous. Just take Terra, for example. Terra, which the ticker symbol is Luna in the crypto space. Last week, it was one of the top 10 largest cryptocurrencies on the planet, right? It was a top trending cryptocurrency. And then you literally have a breakdown of its mechanism. We don't know exactly what caused the overall breakdown in Terra. And you may not be following this, but if you haven't heard, Terra has a stable coin known as Terra USD, UST. And this particular stable coin, which is supposed to be worth $1 at all times, and when it's not, arbitrage moves it right back to that dollar level. We recently saw the Terra USD, this stable coin, which was the fourth largest or third largest stable coin, I believe at the time, get cut dramatically. So right now, as we record this, the stable coin, the Terra stable coin, which is supposed to be always $1, is currently trading at 68 cents. It's going to take some time, perhaps, for this stable coin to get back to the dollar level. Well, in the meantime, Terra, the underlying cryptocurrency, which is one of the top 10 cryptos in the world last week, is now, and was trading above $100 even recently, is now trading at less than $2, right? So it fell 98% over the last 7 days. 98%. I mean, that is wild volatility, right? So you just can't quite be prepared for a 98% drawdown. I mean, it doesn't matter what market you're in. How do you prepare for a 98% drawdown? You know how you do it? By limiting the amount of money that you put into that market. You see, anything can happen in these markets. And this is a wonderful wake-up call for those who perhaps have been thinking about, moving more into crypto. That's fine, but make sure that whatever you put into the crypto market, you are okay with losing, right? And make sure you do your research. Now on Terra is a great example. It was one that I was really considering adding. I had been looking at Terra for some time. I had even told our members, this one looks interesting. I haven't added it yet, but I was looking at it. And sure enough, this thing simply imploded. Now, whether it gets back to break even or not, we'll just have to see. But stablecoins, are controversial, and this project just simply didn't make it. In fact, you may recall, those of you who've been around the block in crypto for some time, you may recall the very first stablecoin ever came out in 2014. It was called Nubits, and it even predates Tether. Tether, of course, has been around for some time as well as a stablecoin. But Nubits was one of the very first stablecoin. It lost its peg back in 2016 for about 3 months. It fell to like 20 cents. It finally got its peg back and was at $1. And then in 2018, it just collapsed again and then just went to zero. So, stablecoins can go away. They don't they're not guaranteed. They're not backed, by the full faith and credit of the federal government or anything like this, like the U.S. dollar is. So you're really, trading and investing at your own risk in this very wild west when it comes to crypto markets. So again, that's why we limit our amount of money that we put into cryptos to just 5 cents out of every investable dollar that we have, each month, each year, each week, whatever the time frame is. It's just a nickel out of every dollar. We've been asked numerous times, why don't you put more into crypto? Well, we began investing in crypto back in 2011, 2012, and we just kept it at that 5 cents out of every dollar. We've been very happy with the returns, and we've also seen dramatic, incredible amounts of volatility. Of course, even with that, small number that we put in. So, are we facing a new crypto winter? Are we in the grip of a brand new crypto winter? I believe there's no way to deny it. I believe it's arrived. You can even see the potential problems here lurking in even Coinbase. Its latest earnings report. Coinbase reported a loss of $1.98 per share. That was well below forecast for a 1 penny loss per share. And the sales were well below forecast as well. Analysts had expected a $1.5 billion revenue print for the quarter, and the company brought in $1.16 billion. And so the stock fell immediately, like 16 or 17% on Wednesday after the news. And so, you do have, Coinbase, which is kind of a bellwether in the crypto market. You really want to watch that as kind of a bellwether in the market for the overall crypto market. And so cryptos and stocks both, really getting hammered. Now, as I mentioned to you before, I was telling you the three things that we could see a turnaround in. I had mentioned to you that we could see a turnaround in the inflation print. If we started to see that inflation had topped, investors would say, okay, this is good news, and they would probably begin to start building positions again, or adding to their positions or buying across the board. Also, we had mentioned that it's possible that we could see stocks fall to certain levels to where it just kind of triggers automatic buying. Well, there's also a third option, and the third option is the fact that the Federal Reserve could signal that it is not intending to do more rate hikes. That, of course, if it makes a pivot, if it begins to say, we're not so sure we're going to continue down this path, or we're open to the idea of not raising rates. Well, if they did that too early, that would probably be strange. People are expecting more rate hikes. They want the Fed to do that. But if the Fed begins to pivot earlier than expected, that could also be something that would be dovish for the market. So, but right now, I think it's just very tumultuous. The volatility is very likely going to be lingering here for some time. Trying to call the bottom in the markets here is like trying to catch a falling knife. And so, the way I look at it is that if you're a trader, this is a great opportunity for you to test out some different strategies. If you've already tested them out on paper, obviously you can get out there and use a small amount of money to trade and see if you can make money in this environment. There's plenty of ways to do that. But then also, if you're a longer term investor, volatility is not the worst enemy. As I was saying earlier, it's not your worst enemy. It's not the greatest risk. The greatest risk for you as a long-term investor is that this near-term, or this volatility that's occurring right now, would cause you to take your eye off of the ball of your long-term goals and begin to do things that maybe you're done out of emotion. We talked about this on last week's podcast, the psychology aspect of the stock market. And even though, the market is selling off, and even though there's a lot of fear here, that's where opportunity is also. With every crisis, there is opportunity. So that's one of the things that we've tried to stress to our own members here, is that don't let the current market volatility determine your long-term plan, right? Near-term events are just near-term events, and they can't have an impact. They can't cause you to change your entire long-term strategy unless those near-term events are so devastating so as to change your overall long-term plan. But again, oftentimes that can just be rooted in emotion. So you may just be making an emotional decision. So my point is that if you have a long-term investment strategy in place, and right now you're dollar cost averaging, for example, into stocks or whatever you're doing, mutual funds, then what I would do is I would not stop that now. Many people make the mistake of investing when the market is high, but when the market crashes or goes down, they stop buying, and you think, well, that's if you're happy to buy the S&P at this price, then why not buy it 30% lower, or 20% lower, whenever it goes down. So whatever your plan is, stick to your plan unless you are changing your plan. But if you are changing your long-term investing plan based upon near-term volatility, then rethink that. That you need to have something much more substantial than just near-term volatility to cause you to change your overall long-term investing plan. So stick with it. With everything going on, I would encourage you to stick to your long-term investing strategy. Now, if you don't have a long-term investing strategy, or if that doesn't describe you, well then, that would be something that you might want to do. You might want to sit down and say, I need to come up with a plan, because now with the market coming down the way that it has, it could be a really good time for you to begin creating that shopping list. If you don't currently have an investing plan, you can start creating one and saying, look, here's what I want to do. Here's how I want to get spread out across the market in a responsible way when the market really pulls back and provides some good opportunities. So again, I would say trying to jump out there right now and thinking that this is the bottom is probably not the way to view it. There's probably much more volatility ahead. We've been in situations like this, and you can, my gut is telling me that there's more downside ahead. Now, I could be wrong. We may rebound from here, but I suspect there's more scary selling ahead before we finally hit that bottom. But trying to time that bottom is also kind of fruitless. So my advice to you would be to, if you already have a long-term investing plan, just stick with it. Just keep doing what you're doing and try to ignore the near-term volatility, because all you're doing is buying more of what you were buying before. You're getting more of it. So I would strongly encourage you that. And if you don't already have an investing plan, then consider this sell-off your opportunity to start building a nice little shopping list of the things that you might want to start dollar cost averaging into with the prices, pulling back. I think there's a lot of great opportunities. And if you're looking for opportunities and you don't know, or maybe you don't know how to find those opportunities, one thing you can do is become a member here at Follow the Money. Follow the Money, we teach investors and traders all around the world how to profit from the markets, whether the markets are going up or whether the markets are going down. So you can certainly learn more about that over at followthemoney.com/join. One final comment I want to make here is that debt continues to be a problem. And I think this is also a problem here as we go forward, is that interest rates are rising. Many people are now moving towards adjustable rate mortgages because fixed rate mortgages are so much more expensive. Well, those adjustable rate mortgages, are kind of a double-edged sword. We'll see how those work out. As rates go up, of course, those will too. And you can always refinance at some point when rates eventually go back down. But the latest total household debt here in America, the latest report put out by the New York Federal Reserve, their quarterly report on household debt and credit, came out this week, and it showed that total household debt rose by $266 billion in the first quarter of this year, and it has now reached around $15.8 trillion. That's up $1.7 trillion from the end of 2019. The majority, by the way, of the increase in those household debts are mortgage balances, which were practically the majority of the increase. They're about $250 billion in the first quarter. You also have credit card balances, which experienced the largest quarterly increase in 22 years last quarter, or I guess I should say in Q4 of 2021, and they're still elevated. So credit card debt is pretty outrageous. Now, when it comes to foreclosures, we've seen some foreclosures pick up in the wake of COVID, but even after all of the mortuariums on foreclosures, we really haven't seen that many. According to this latest report. And 68%, I thought this was an interesting statistic from this report, but 68% of the newly originated mortgage debt in Q1 of 2021, going back to last year, went to borrowers with credit scores over 760. Now, as a landlord or as a real estate investor, we rent out to tenants often, and we look for a credit score of at least 600. 600, anything higher than that is even better. 640 is even better. Well, anything below 600, we typically will not consider for our rental properties. Well, this shows that nearly 70% or 2/3 of the mortgage debt that came in the first quarter of 2021 went to borrowers with credit scores of over 760. So what that means is that it's not the same as what we saw back in 2008 when we had all of these subprime mortgages and, people couldn't afford their houses because they were, liar loans or low doc loans or no doc loans. So, kind of a interesting point there. So the housing market, even though it's outrageous and stretched and the prices are outrageous as well, the concerns there are not as great as we see right now in other areas. But the housing market is very hot. It's certainly going to have to pull back at some point. The rates will eventually cause a shift in the behavior. But there's just a tremendous amount of under building across the country. I mean, even in the area where I'm at here in the Midwest, there's just so much underbuilding. We need, more units. We need more houses. We need more apartments. We need more college housing. There's just not enough. America is underbuilt. And so with that inventory being tight and many people trying to buy their first home, and then, of course, interest rates being low for that period, it just created this noxious combination of just explosive housing prices. We don't expect that to continue, year after year after year here because A, prices don't go straight up like this. But secondly, the prices are really a function of the interest rate. When you raise interest rates enough, the people can't afford, the housing prices as they are. So, we expect to see housing prices begin to, in fact, you're already beginning to see it in some areas where they're flattening out. Some of them are even beginning to curl down slightly, but just a few areas. So anyway, there's a whole lot there we wanted to talk about. So real estate, cryptocurrencies, the stock market, right? And debt. If you are facing debt, if debt is a problem, if you're concerned about your debt loads, we've actually created also a free report for you, a downloadable report, a podcast, and also a spreadsheet, a sample spreadsheet showing you how you can pay off your debt fast. We have a debt stacking strategy that we teach here at Follow the Money. You can go download it for free. followthemoney.com/debt. Take advantage of those free resources. And if you know someone who is struggling with debt, this really cool debt stacking strategy shows you step by step how to pay off your debt quickly. I'm talking about paying off everything, not just your credit card debt or your student loan debt or your auto loan debt, but I mean everything, including your mortgage if you're so inclined, so as to pay all of that off within, 7 to 12 years. A really powerful debt stacking strategy. So you can check that out, followthemoney.com/debt. And if you're interested in becoming a member here, we'd love to have you become a part of our global community, investor community. Learn how to trade, get our daily trading idea, daily commentary from me by your email. All of our members get so many things. Feel free to learn more about us at followthemoney.com/join. All right. So on the other side of this break, we'll be back with our second segment. I'm going to be joined by my good friend and longtime financial advisor, Mike Mitchell. He's here from our Christian Advisor Referral Network. And we're going to be talking about Social Security. We have a question from one of our gold members about whether or not they should take Social Security early at the age of 62. Mike and I will discuss the pros and cons of that strategy on the other side of this break. Hold tight. All right, friends, welcome back to Follow the Money Radio. And again, we're joined by my good friend and longtime financial advisor, Mike Mitchell. Mike, it's great to have you here for another segment on retirement strategies. Thanks for joining us.
Good to be here, Jerry.
Well, we receive lots of questions here, as we've talked about before in the past. And today we're going to be talking about Social Security. We have a great question here from one of our gold members named Annie. She lives up in Crested Butte, Colorado. Here's her question, Mike. She says, I'm 62 years old and single. She puts widowed in parentheses. And she plans on working a few more years, especially with the current market volatility. She says, my question is related to Social Security. I'm wondering if it would be wise to begin taking my Social Security benefits early, or would it be better to wait until I reach full retirement age? I know I would receive a higher monthly benefit if I wait until my full retirement age, but I could use the extra income now to pay down some debt and invest more. Thanks for all you do, Annie G, a gold member from Crested Butte, Colorado. Now, she does mention, Mike, in this that she does have some debt to pay down. I don't know how much debt she has. She also wants to invest more. I would assume she would be investing for the purposes of retirement, of course, which is coming up soon, she says. So that's her logic. She's thinking about maybe taking it early to pay down debt and invest more versus, and it sounds like she might be able to do without the income because she was just going to use it for other purposes. So if she doesn't necessarily have to have the income now, is it a good idea?
Yeah. There are several layers to that particular question that I think it bears kind of focusing on. The very first thing that I would ask her to think about is, the priorities, the levels of concern that she does have about debt and where she stands with regard to debt, as opposed to her actual income needs. I think it certainly makes sense to pay down the debt. That always should be a very high priority for everyone. But you should also keep in mind that when you start taking benefits early, at age 62, that's the earliest that you can take them. You have to remember that you are about to take a permanent reduction of your Social Security benefits. That the other component that plays into that whole discussion is the issue of health and longevity. So if you're starting earlier on less money and you're very, very healthy and you've got maybe a very long time to live, there's longevity in your family background, which is always kind of murky. That's always a murky topic to get into because you never know. It's not an automatic given that if you have longevity in your family background, that's going to extend to you as an individual. But it does come into play when you're taking benefits early and you're taking a reduction of benefits. So I would say that needs to be looked into. Pegging the priority of just, how much debt you have, how much income you really need from taking benefits early, and interfacing that with your health and your longevity questions. Keeping in mind that you're going to be establishing a permanent reduction of your Social Security benefits. Those all have to be calculated into a decision like that.
Yeah, it can definitely change the whole trajectory of your retirement. It all depends, on how much money she has in debt repayments that she has to make, how much money she has in investments now, and the current market volatility. Since she brought that up, let's just talk about that briefly. I know that really won't age well if someone's watching this, say, 2 or 3 years from now, but just for those who might be encountering future market volatility, if they're seeing this video, right now we're living through a time of great market volatility. What impact should that have on her decision? Is it an important thing to keep in mind? At her age, at 62, what kind of advice would you have for someone who may be concerned about market volatility?
Well, it's vital. I mean, it's probably one of the most important questions people who are facing retirement or about to go into retirement, or maybe who are actually in retirement, need to deal with. And that is, if your income, that your retirement income is somewhat tied to, fixed levels of income, and possibly you're pulling from established investments, market volatility can knock a big hole in that really, really fast. Mm-hmm. And so I think by its very nature, being able to position yourself with less risk in the period of time that you're going to be going through retirement and maybe have restricted income levels or having a greater dependency on investment positions, market volatility can be a very problematic issue. So I think you really need to pay close attention to your risk tolerance when it comes to retirement and market volatility.
Good insights from Mike Mitchell. He's a part of our Christian Advisor Referral Service. I would imagine if Annie wants to reach out to you directly, I'm sure she'll hear this. She could reach out to you directly and get very specific information. There's probably also other people out there, Mike, who are listening to this and saying, I have similar questions about my Social Security. If they want to talk to you directly, explain to them how they can do that.
Yeah, we have a toll-free number that anybody can call directly into us and get a conversation started. That number is 833-370-0777. And they'll be able to get directly to me through that call, and we'll certainly reach back out to them quickly if they can leave a voicemail. If they don't get us live at that point, certainly there's an opportunity for a voicemail. But if they'll call toll free 833-370-0777, we would love to have an opportunity to have a conversation with them.
If you have a question about Social Security, retirement strategies, even market volatility and how to handle it as you near retirement, give Mike Mitchell a call. He's part of our Christian Advisor Referral Service. We've been working together now for many, many years. It's such a pleasure and an honor to work with you, Mike, to help these people who, so many people need a money guy. And I'm so grateful that you're there to help. So we'll look forward to this again next time. And until then,
Absolutely.
God bless you, my friend. Thank you.
You too, Jerry. Thanks.
All right, friends, I hope you enjoyed that interview there with Mike Mitchell. If you have questions about Social Security, I encourage you to reach out to Mike as a listener here at Follow the Money, or even a member here at Follow the Money. Just reach out to Mike, let him know you're here with Follow the Money. You heard about him here, and he'll roll out the red carpet and answer your questions about Social Security. He's here to help, and I sure hope that you'll take advantage of it. Or if you have your own trusted financial advisor, reach out to them. Hey, you know what? One of the most important concepts in the world of finances is wise counsel. You want to surround yourself with wise counselors in this space. It can be very, very helpful. All right, well, I hope you've enjoyed today's podcast episode. It's really been fun. So let's bring this now to a close. And as always, I like to leave you with a final word, this time taken from the book of Proverbs, chapter 11, verse 25, where it reads, "A generous person will prosper, and whoever refreshes others will be refreshed." And that's just something to think about. And remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.